Okay, so the 30-minute generational wealth masterclass for women. This is a complete framework for women ready to build, protect, and scale. Today we change the narrative on excuse me, what it means for women to be able to be better at saving, budgeting, and spending wisely. Nobody taught us these things when we were young, which was an actual which was disparaging for us because many of our other counterparts they have already have learned to do that. So in the next 30 minutes, I'm going to talk to you about how you build, how you invest, and how you protect the wealth that you've amassed and that it outlives you even when you're gone. So the masterclass has four pillars. It has a mindset, financing, equity, and protection. The mindset is to shift from being a buyer to an investor. So instead of you just seeing a place as a someone for you to live, you're actually looking into it in the investor's eye, where someone's going to be renting from you, or if you're going to be buying and flipping, financing, you're going to know a full range of options instead of the typical norm, traditional, FHA and conventional. And then you're going to learn how to activate what you already have, which is your equity. And then lastly, you're going to be able to protect everything that you've amassed through the years of you building your wealth and make sure you're able to pass it on forward. So we're going to go ahead and start with pillar number one. Pillar number one is the investor mindset. So with the investor mindset, Miss Patricia, the numbers are clear. Women live 5 to 7 years, a lot longer than men. And this requires a lot more retirement savings since we live men from 5 to 7, an average 5 to 7 years. The gender gap pay costs women over $400,000 across a 40-year career lifespan. And then also 90% of women will go solo, meaning that they will either be single, they will either be a widow, because again, we outlive men, or we're going to be divorced. So that's not something that was made up. This is statistics. This is statistically proven, Miss Patricia. Again, 90% of women will be alone. And then there's a huge net worth edge that women, homeowners have a median net worth of 40 times higher than renters. So again, 40 times, you're 40 times wealthier than the average renter. So the power of leverage is if you put $60,000 on a $300,000 home, it appreciates 5%, and you gain $15,000. So that's a 25% on your cash, even though the bank finance 80% and you capture 100% appreciation. So buying to live versus buying to build. This is one of the things that I had taught Miss Patricia is that when you are buying to live, you're more apt to choosing your finishes, meaning, the crown molding, lighting fixtures, window fixtures, window panes. You are more budget maxed out, meaning you're going to try to buy the best or the most for your buck. So if you have a budget and if all the boxes check, you're more likely to max out the amount that you're pre-qualified versus just taking something nominal to live and living way below your means. And then when you are buying to live, your plans is usually to live forever. Now, when you are buying to build wealth, Miss Patricia, you choose your location that has potential growth and that shows not a declining, but you're choosing an area that shows growth exponentially economically. There's great schools there. People want to live in the area. So you're that's what you're deciding. That's the type of mindset you're using when you're buying to build wealth. Now, when you're buying to build wealth, your budget leaves room for the reserves. When you're looking to purchase, you're looking for the best price because at the end of the day, you're not living in this property. Someone else is going to be renting this property for you. So you're less inclined to try to find something that has these finishing touches, and you're not buying emotionally. You're buying financially, and you're buying based on the economics of that area. And then lastly, you're more than likely to hold on to that property 5 to 7 years, and then you will create an exit strategy, whether it's to sell it or you're going to pass it on to someone else, or you're going to sell it in its entirety. So your first home doesn't have to be your forever home. It can be your first investment home. Miss Patricia, are you already a homeowner?
No, I'm not.
Okay, perfect. That's a perfect, and actually, and that's a good thing, because now you have a blank slate to what I'm going to be telling you, because a lot of times when people buy, they come in with, after they've purchased, they already have a mindset. They've already created a mindset based on their experience. So I wanted to do this. I'm glad that you haven't purchased before, because this is an excellent way for you to learn how the market works, from an outsider looking in. The second pillar is,
So
mhm,
let me correct you. It's not that I've never bought before,
okay.
but it's been a lot of years. It's about 20 years. Uh,
Oh, okay. So my apologies.
I have, it's just as if I'm a first,
Home buyer,
home.
got you. Okay. Okay, okay. Got you. All right. So since you haven't purchased in 20 years, you're still at a good entry point to purchase, because again, a lot of things have changed since 20 years ago, and they've made a lot of great programs, a lot of great strides for new homeowners. So I'll go ahead and tell you about that at the end. So the second pillar is your financing like a strategist. So what that means is that debt is not the enemy, it's a precision tool when deployed correctly. So knowing your full menu of options is what separates a buyer from a builder, Miss Patricia. So you have five different types of loan tools or debt tools that you can use to build up your investor arsenal. So you have what's called your FHA loans. FHA loans are government-backed loans. They typically allow you to put just 3.5% down, where the next loan can require you to put a lot more. Um, this is perfect for a house hacking, meaning, let's say you buy a duplex mix, Patricia, you live in one side and you rent the other side, and that can actually pay your entire mortgage off, where the monies that you have, that you maybe work or retirement or pensions or alimony, you can actually use that money and save it as your reserves to go on and purchase your next home. These are great because, again, they are a lot more lenient with the interest rate and lenient with the down payment than your non-governmental loans. And again, you're only required to put 3.5% down, and they will go as low as 580, and some lenders will go as low as 550 for you to purchase a house. Your next type of loan is conventional. They can go as low as 3%. I'm going to talk to you about a particular loan that does such at the very end. You can finance up to 10 properties, Miss Patricia, simultaneously, where with FHA you cannot. So what that means is, let's say that you bought one house, and then you lived in it, but then you decided you wanted to use that house that you first bought, because you didn't exactly love it, but you saw that it was in a great economical area that allows for growth and potential, and you know that people want to live in that area, and you decided, I'm going to buy this property. But then you go ahead and then you bought another house, and now the first house that you have, you're using it as a rental. You can do that up to 10 times via conventional loan, and you will not get penalized for it. Whether you put 3% down or you put 20% down, you get to do that on conventional financing. Conventional financing, they're not as stringent as FHA. FHA is a government loan that will look at they will look at your assets, they will look at large deposits, they will look at your credit. If you had a student loan, they're going to ask you, If you hadn't paid it back, what are your plans to do so? Because they will not give you another government loan if you're not taking care of the current loan that you borrowed from them. The next one is your VA loan. VA loans are for veterans. This is a zero down payment type of loan, which eligible veterans and surviving spouses are qualified. Are you a veteran, Miss Patricia?
No, 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 I'm not.
Okay. Were you ever married to one?
No, I don't have, I'm not connected to
Anybody?
a veteran. I mean, yeah.
Okay, okay, no problem, Miss Patricia. So with VA loans, these are another type of government loans, and these are loans for veterans who serve in all of the branches of the Army. They typically put nothing down, and with these loans, they usually have great interest rates. Um,
Mhm.
so the next one is your non-qualified mortgage loans or your bank statement loans. These are for those who have unpredictable income, so they don't qualify for like a W-2, not a W-2, a paycheck, or maybe a
Mhm.
W-2 that they could show that the money's being deposited into their account every single month, and so they will use their bank statements to qualify for that. Now, to use this type of loan, you have to provide either 12 to 24 months of bank statements instead of your
Mhm.
tax returns that you would see on the first three loans that we talked about. And
Mhm.
then you write off your write-off no longer disqualify you. So meaning those who typically you work off of bank statement loans, they're typically 1099 employees or businesses that they when they doing their taxes, they're filing under a Schedule C, which is for those who do not have taxes withheld. So if for those people, they will write off as many expenses as possible so they don't have to pay as much of a large a refund amount or return amount to the IRS. So this loan is designed specifically for people like that. Now, your last loan is called your DSCR loan, which stands for Debt Service Coverage Loan. This type of loan qualifies your property, not you. So meaning the gross rental income would equal your principal, interest, taxes, insurance, and association in some cases, Miss Patricia. And
Mhm.
so if your mortgage is, let's say, $1,000, Miss Patricia, and
Mhm.
your rent that you're collecting is $1,000, that would make your loan actually work. So the bank is not qualifying your income, they're not qualifying your tax returns, your pay stubs. They're only just going off of the rent that's being collected on that house. And for some lenders, they want it to be one and a quarter, meaning if your mortgage is $1,000, they want your rent to be at least $1,250 because they know that you're going to have a year lease and they know that you're going to be collecting steady rent for at
Right.
least a year, meaning that you're going to be paying your mortgage payments on time. So
Right.
that's a really cool loan. Again, it doesn't qualify your income, it just qualifies the rent. Now, the five question capital stack framework goes as follows. What is my holding strategy? So when you're factoring purchasing an investment, you need to know what your holding strategy is. Are you going to be holding it for the long term? Because let's say that you had like a fourplex in a very busy high traffic area where there's a bus line, there's lots of, stores, shops,
Mhm.
schools, parks, places like that. Or
Mhm.
do you see yourself just maybe holding it, you're fixing it up and you're flipping it? That's something that you need to think about when you're getting ready to purchase. The next thing is, does the property qualify for agency financing? Agency financing, Miss Patricia, is is does it qualify for FHA loan or does it qualify for conventional loan financing? So FHA loans, again, is a governmental backed loan that, again, they look at thing, um, every single thing in your credit report, and they look at
Mhm.
every single thing in your assets as well.
Mhm.
And the next thing is, does my income support conventional underwriting? So underwriting is a term where the bank will go ahead and pre-approve you, they'll approve you on the condition that you provide documentation showing that you are qualified to get a loan from these from the lender,
Mhm.
right? And
Yeah.
then the next one is, oh, what I wanted to say about does my income support conventional underwriting? So they're gonna look at your tax returns, they're gonna look
Mhm.
at your W-2s, they're gonna look at your pay stubs, they're gonna break it down from all of the, let's say if you have bonuses, you have overtime, you have all these different things on your pay stub, and
Yeah.
they have a very sophisticated way of calculating to see the longevity of you receiving those types of those types of income.
Mhm.
And
Yeah.
the next one is, does the deal need speed or flexibility? What that means is, have you ever heard of a fix and flip?
Yes.
Okay, perfect. So typically when you have a fix and flip, it means that you are buying a property that is completely distressed, meaning it needs a lot of love. When it means a lot of love, Miss Patricia, it means it needs a lot of repairs.
Mhm.
So what that means is you either have the capital to fix it, or there are loans that will give you the money to fix up the repairs because they know that if you fix it up, that means you can sell it for a higher price.
Yeah.
So, or does it need flexibility? Meaning, I'm flexible with, I could either, it's either or. You could either sell it quickly, or it's good enough to hold it long enough to
Mhm.
collect long-term rent. And lastly, can I optimize this with a partner, of entity, or creative structure? So a partner meaning you can go in with your sister, you can go in with a friend to partner up in buying this house or investment
Mhm.
property, or are you going to create an entity like an LLC, a corporation, to purchase it, or are you going to do it creatively, where you can do creative financing through the seller who's purchasing it? So the broker advantage is a bank has one menu, but if you work with a wholesale lender like myself, you can have your access, you're privy to 30 different types of lenders. There's so many different types of programs for your needs. The next pillar is extracting um, wealth with equity. So do you know what equity is, Miss Patricia?
I do.
Tell me what equity is.
So equity is basically the monies that you paid when you take out the payment and I think the interest and the leftovers build up is what you build up as equity. That's what that understanding of it is.
Yes, exactly. So equity is really simple. It's the value of the house minus what you owe the bank, and whatever's left over, like you said, that's your equity and that's yours. So the third pillar, like we're gonna now discuss, is extracting wealth with equity. So equity again equals home market value minus the outstanding mortgage, and most owners, they sit on this equity unused for decades, and they don't even use these tools to put it to work. So that's the reason.
Equity because people
Hmm.
don't understand equity. I know what it is, but I still
Hmm.
don't understand it completely.
Oh, okay. Well, so now this pillar is exactly for you to help you understand how equity works. So,
Mhm.
okay. So there's two ways that you can tap into your equity, Miss Patricia. You can tap in through a cash out refinance, or you can tap into your equity through a HELOC. And I'm gonna go over the differences. So a cash out refi, Miss Patricia, it replaces the entire mortgage. However, you're allowed up to 80% of that equity of your house, and you can use it to, pay down debt. You can use it to buy a whole different property. You can use it to renovate your home. You can even use it in the event, like God forbid, you have an emergency. You need to do an emergency surgery that your insurance provider doesn't cover. there's lots of ways that you can use that equity. The equity is it replaces your current interest rate and you get one lump sum. And then again, it resets your loan, all the loan terms. So if you were like a couple of, I don't know, 20 years away from paying off your mortgage, and then you could reset it to 30 years. But now lenders have gotten very sophisticated, Miss Patricia, that you can actually, they're a lot flexible with the mortgage terms that you can do 27 years, 24, 25, 28 years instead of starting the 30-year period all over again. And then last but not least, it's very good for large investments. So let's say you buy a house and you have about $250,000 and you're allowed to take 80% of that $250,000 on a down payment for a fiveplex. That's what these types of loans are for. Now, HELOCs are treated like basically credit cards or revolving lines of credit. Your house is used as a collateral. Now, you only take what you need. You do not take all of it. So just like on a credit card, you go to the store, you have a $10,000 limit, but then you're only using, I don't know, $7,000 to buy a washer and dryer, and then you're left with that $9,000 left. That's what a HELOC is. Now, the HELOCs, their interest rates are not fixed. It changes every month, and it's based on the market. So whatever the market is that month, that's what your interest rate is. Again, you only take what you need, and then it preserves your current existing rate while you have a variable interest rate on the amount that you borrowed, not the entire equity. And lastly, it's best if you already have a low interest rate. So during the beginning of COVID, a lot of people benefited with 2%. Some even got like a 1.9. I did a loan for my friend. I think she got like a 2.5%. So for someone like her who doesn't want to touch her interest rate, she would just go ahead and get a HELOC and use the money that she needs to either, make repairs or do whatever she needs with the money.
Okay,
Um,
so what happened when the interest rates, because isn't interest rates high right? Is it interest rate high right now or is it low? It's high.
Okay, so it varies. So it depends on the type of program that you get. The interest rates are pretty decent for like FHA loans that we talked about, the governmental loans and the conventional loans. Now, when it comes to the non-qualified mortgage loans that I told you about, the non-traditional ones, those interest rates are usually like 1 to 2. No, they're usually 2% higher than your traditional loans. So again, the interest rates are tied to the market. What I can do for you on another day, I could give you, I can tell you what the interest rate is for the day. Now, another thing is interest rates, they change every single day. They never stay the same.
Yeah, I'm aware of that. I
Okay,
mean,
good.
I understand how that and how
Mm-hmm.
that changes. I also understand how it affects variable loans because
Perfect.
if you have a variable loan and the rate becomes very high, then it means that you owe a lot of money at the end of the month. Sometimes I've had a friend who had a variable loan from Wells Fargo, I think, and her mortgage was like 1,200, and at the end of that month, when it went up, it was like almost 5,000. So it was like a
Yeah.
big jump.
Right. So that what you're talking about also, there are arms. Arms are adjustable rate mortgages that those interest rates are good for like they have the between 3 to 10 years. And so after the 10 year, after that, the 3 to 10 years is up, the interest rate will go up 1 point every year until that person refinances. Now,
Mhm.
those loans are good if you know that you're not going to keep the house long, or it's good if you know what you're doing and you know that, okay, and you bought it at a really low interest rate. And then you're like, okay, I'm gonna take my chances and I'll wait till when it's about to be up and refinance it and get a different type of loan. Either you get another arm or you get a fixed 30-year. Does that make sense?
Makes sense.
Perfect. So the next thing I wanted to talk to you about is the buy, rehab, rent, refinance, repeat process. So what that means is you buy the house at a you buy a distressed property below the market value, right? So we talked about that. You buy a house that needs a lot of love. But then
Mhm.
you go ahead and you rehab it to bring the value up through the improvements. So whether it's roofing, you needed to do the flooring, you needed to maybe re renovate the bathroom, the kitchen. By you doing that, you increase the value of the home, and then you turn around and you rent it to generate consistent cash flow. Now, once you have enough value in the house, like we talked about, the value minus the mortgage equals the equity, you go ahead and you refinance that same house that you bought at a very low value or a low price, and you take the equity out to recover from your investment, and then you start the process all over again. And it works. I have a friend of mine who owns about 8 properties, and she did that. She did that process where she bought the house, she renovated the house, and now she rented the house. She waited a little bit, and then she cashed it out, and then she repeat the process 8 times. So now she has
Mhm.
8 properties, some here in Broward County. I think she might have one in Miami, and then she has some in
Mhm.
Palm Coast. So that's basically the process in investing.
You say you have to have the capital to purchase the house in the first place. But then you're getting a loan to do the repairs. That's what you're saying?
Say that again.
Do you have to have the capital to purchase the property in the first place and then get a loan to do the repairs, or are you getting a loan to purchase the property and do the repairs?
Okay, so you have 2 ways of doing it. If the house needs a lot of love, and let's say you do have the capital to put down the down payment, then you can get one of those fix and flip loans that's going to give you the money to buy the house, and they'll give you money to repair the house. Now, if let's say you ended up finding a house that doesn't really need a whole lot of repairs, just maybe minor things that could be negotiated to the seller to make the seller fix those payments. I'm also a realtor too, if you ever need help. I do both. So let's say you find a house, right? And it doesn't need a whole lot of work. And in this market, in today's market, you ask the seller, hey, can you fix these items before we close? The seller is more than likely going to do it because the seller is going to want to sell this house because there's a lot of inventory just sitting there, Miss Patricia. And so what they're going to do is they're going to go ahead and fix that property. Now, let's say you didn't have the money or the complete amount of money to put down on the house. There are loans in place to give you that will pay your down payment, and they actually are forgivable. That those type of loans are called down payment assistant loans, and they do allow for duplexes, and in some cases up to 4 units or fourplexes. And all you have to do is live in it and live in one side, and it'll offset the entire mortgage by you having a tenant or tenants living in that property. Does that make sense?
Makes sense.
And then by them paying your down payment, later you can use the reserves that you have or you can wait a little bit to do a cash out refinance to buy your next investment property while
Okay.
you received free money from the bank. Does that make sense?
Makes sense. Makes a lot of sense.
Perfect. I'm glad you understand that. So there's a lot of easy ways to get into the investment market. You just have to, be strategic, and you have to, pay attention to the market. And then what I wanted to say that the 3 property roadmap in 7 years look like this. So years 1 and 2, you stabilize. You're building the reserves. Reserves is the money that you set aside that in the event of an emergency, the reserves is there to, pay your mortgage, and also pay your closing costs. You also get pre-approved. You get pre-approved to see exactly what you qualify for and how much you get qualified. And that is this establishment of your foundation. Years 2 and 3, you buy your first rental. You use either a HELOC or the cash out refinance for the down payment on the house that you first bought when you pre-approved during years 1 and 2. And in years 3 and 5, you build your equity across both properties, and then you consider that process that we just talked about. You buy, rehab, rent, refinance, and repeat.
Mhm.
And then years 5 and 7, 5 through 7, you buy your third property where your assets now fuel each other and the flywheel spins. So basically, you're no longer using your money anymore. You're using the equity from the other properties to buy your investments going forward, and you're not even touching your money.
Right.
Right.
Fantastic.
Exactly. So now we're on to the very last pillar, which is your protection and your legacy. So what that means, Miss Patricia, is this. You have two ways of buying your property. You can either buy your property with your name, your personal name. This is good for financing access because, like I told you earlier, your FHA and conventional loans or traditional financing will give you the best interest rates. But it puts the full liability on you. What does that mean when I say the full liability on you? It means that let's say you have a tenant living in your home, in your one of your rental properties, and you bought it under your name, and then God forbid something happened where the roof collapses on them while they were asleep. Your all of your assets, everything that you've amassed is exposed, fully exposed,
Mhm.
and they can come after them. Now,
Mhm.
if you buy under an LLC, it separates you legally from your assets. Your personal assets become sheltered, and it is a little bit harder to finance. However, there are a few lenders that are making it easier for you to purchase under an LLC because um, for them, I don't know, some lenders now prefer that you finance under an LLC than in your own name. Or what you could do is you can buy in your personal name for the best interest rates, then transfer ownership to an LLC after you close with a deed transfer and umbrella insurance. So those are the differences between purchasing with your name and an LLC. Now, the next thing that you need to also think about is your estate planning. Estate planning it allows for your loved ones to not have to go through probate because probate can take years. The more siblings, the more children that you have, the more it can take longer because it causes it causes the court to take longer with the process whenever someone makes a claim to your estate or make a claim to your assets that you've amassed while you're alive. So you have different ways of protecting your estate. You can do it through a revocable living trust, which bypasses the probate process in its entirety. So whenever you have a trust, you don't have to go to probate. It just passes on to your heirs. And also your assets transfers onto your heirs privately, directly, and quickly. Because when you go through probate, everything becomes public in case it gives your loved ones, your loved ones an opportunity to make a claim to your estate. So everything is done fairly. Another thing is with estate planning, it allows for you to choose a power of attorney and a healthcare directive, which protects you during the moments that you're incapable of making any major decisions, and not just death. Also, without a trust, your probate costs could cost 3 to 7% of the estate value. Again, it's made public, and it's a slow and arduous process. Another thing about protecting your legacy is tax strategies. This one I'm going to tell you, I'm not an accountant. I'm not a certified accountant. Consult your accountant when it's time to do your taxes for your properties. You have 4 different types of tools that can assist you when you're building your investment portfolio. You have depreciation where you can deduct the wear and tear over a 27.5 year period for residential properties and 39.5% for commercial. And even if the property is appreciating in value, this is something that you would want to talk to your tax accountant when you're doing your taxes. This is legal, and this actually lowers your taxable income during time. The next thing is your 1031 exchange. This allows for you to sell and defer capital gains indefinitely by rolling into a like kind property. So meaning, let's say you bought a house for $250,000, a single family, one unit. Usually, if you just held on to the money, the IRS would tax you for that money that you made. But if you take that money and you roll it into another single family home by buying another property, that protects you from being taxed by the IRS for that. The only thing is you cannot buy like a single family home and then turn around and buy a condo or a single family home to a duplex or a triplex. It has to be the same type of property that you bought before, okay?
Mhm.
The next thing is filing under a S corporation election. So it allows you to split your LLC income between salary and distributions in the form of dividends. This can significantly reduce your self-employment tax liability, and it actually can benefit you through your retirement by the way you do your election. And last but not least, you are allowed to contribute up to $69,000 a year as a self-employed woman versus $23,000 as a traditional employee, which is a huge, massive tax advantage. So what it means is that you're allowed to deduct, I mean, not deduct, you're allowed to contribute money on both ends. You can contribute money as an employee and you can contribute as an employer. So kind of like think of it this way, you have an employer that does a price match or a dollar for dollar match with your 401k. But when you have a business, you're able to put more money towards your 401k as an individual employee. And as the employer, you can put more money, allowing you to put $69,000 into the account.
Mhm.
And by you doing it that way, um, you get after the money is put into your 401k off the top of your income, you're only taxed for whatever it is that you receive. So this is one of the benefits of being an investor. So we're now coming to the end of the presentation. For this final pillar, I just want to say that the annual gift tax inclusion is $18,000 per recipient per year, tax-free. So 90% of family wealth is lost by the generation because nobody talked about what I just told you. And they hold it annually. Um, most families will hold annual family meetings to talk about their wealth or to talk about money. And this is something that we don't do in our own community.
Mhm.
And then legacy is built through communication, not just through documents. So the more information that you acquire, if you have a son or a daughter, grandchild, niece or nephew that you're very close to, it's very imperative that you pass this knowledge on to them because again, we are at a disadvantage because no one ever taught us this. So this is the end of my presentation. Again, your wealth journey starts this week after we just had this presentation. I'm going to send you this to your email so you can go ahead and view this.
Mhm.
Um, I encourage you with the 5-step action plan is first things first is to know your credit score because your credit score is actually the key that unlocks many, many doors. Consult a real estate attorney in discussing how to structure your corporation, or if you want to use your name, or you want to do a hybrid where you start off buying with your name first and then transfer it into an LLC. You want to establish an estate plan where, if you need an attorney, I can refer you a couple that can help you establish your trust, your power of attorney, and your healthcare directive. And then you want to add an umbrella policy, meaning insurance for your properties. When you have insurance for your properties, like homeowners insurance is if you're going to actually live in the property. You don't want to put homeowner insurance on an investment because there's a landlord policy specifically for that just for tenants. And let's say you did put a homeowner's insurance on an investment property and something happened to the property and you weren't living there, the insurance company has a right to deny your claim because the policy was directly made for you living in that property. And lastly, you want to start the conversation about wealth and with your family because again, we're not privy to a lot of information and how are we supposed to know if we don't teach the generation behind us. So Ms. Patricia, I want to say thank you for allowing me to um, giving me your time for 40 minutes. We actually went over, but that's okay. It was good information. Do you have any questions for me?
Okay, so I was waiting for this part.
Tell me.